This is a video report analysis for Globalstar Incorporated as part of Burke & Road Reports, a program at Tulane University's A.B. Freeman School of Business. My name is Avery Somers, along with our student analyst team of Adam Tannenbaum and Meng Wang. First, we will be talking about Globalstar's stock performance and our 12-month target price. Next, we will explain our valuation method. Then we will provide a brief overview of the company background. We will then talk about our investment thesis. Finally, we will conclude our report. This graph depicts Globalstar's 5-year stock performance. As of November 11, 2014, Globalstar's stock price was at $2.60. We forecast a 12-month target stock price of $3.80 and give Globalstar a market outperform rating. We determined our 12-month target price of $3.80 for Globalstar by evaluating the company in two ways. First, we valued Globalstar's spectrum, and second, we valued Globalstar's core satellite business. Companies that have spectrums use a metric called megahertz to population to value their spectrums, which we likewise did for Globalstar. We took the population of the United States, 318 million, and multiplied the available megahertz of Globalstar's spectrum, which is 10 megahertz, to get the megahertz to population metric. Then, we multiplied the megahertz to population metric by $1, which equals the total value of the spectrum. Then, we divided the total value of the spectrum by Globalstar's shares outstanding and found the value of the spectrum per share, which is $3.63. We also calculated a range of potential spectrum prices and replaced the $1 price with some different prices the spectrum could be worth. The low range we decided on was 20 cents, which gave us a 70-cent share price. The middle range was the $1 price, which is commonly used in spectrum valuations. The highest range we decided to choose was $1.50, which we based on similar historic sale prices of spectrums. This overall gave us a price of $5.45. We felt that our $3.63 price was a reasonable estimate because we were not too bullish or too bearish. For the company's main satellite business, we used a peer multiples method in which we use enterprise value to earnings before interest, taxes, depreciation, and amortization. We used this ratio since it was very hard to value Globalstar based on any other metrics since the company has had consistent negative earnings. We found the core business value to be 16 cents, and we added this to the spectrum value to find an overall share price of $3.08. Globalstar, which is traded on the New York Stock Exchange, is a Covington, Louisiana-based company. Globalstar provides satellite-based wireless voice and data services to government, commercial entities, and retail customers. As of November 11, 2014, Globalstar was priced at $2.60 a share, with a market capitalization of $3.74 billion and 785 million shares outstanding. Next, we will talk about our investment thesis. The company has a highly volatile stock price, and there is a lot of risk associated with it. However, we think that the spectrum will likely get approval from the Federal Communications Commission, or the FCC, which presents several opportunities for revenue and profit for Globalstar. Likewise, while the company has had net losses for 3 years, it recently released its second-generation satellites, which will improve its services and products, and therefore attract more clients. However, the company is highly indebted, and at its current cash flow, it will not be able to pay off its debts without restructuring. The stock price faces a risk of dilution from the many convertible debt options and equity injections by Thermo. Companies that use spectrums cannot own them because they are controlled by the government. The FCC decides which companies control and use the spectrums. Globalstar currently licenses 21 megahertz of spectrum for its satellite business. However, the company has not been using the spectrum to its fullest potential, and there is excess space of 11 megahertz that the FCC is considering repurposing to use for other things. This is the main driver behind Globalstar's stock price because of the potential profits the extra spectrum could bring. For example, the company has tested its new terrestrial low-power service, which is an innovative public Wi-Fi service. Recently, the FCC stated that they are seeking to open more spectrums to resolve the Wi-Fi congestion problem. Based on our research of similar companies which received FCC approval to repurpose their spectrums, it is likely that Globalstar will also get approval. The second-generation satellites will improve services and attract new clients. Globalstar has completed the launch of its second-generation satellites in 2013, which generally lasts between 10 and 15 years. These new satellites allow the company to provide better satellite communication services to its customers. In early 2013, Globalstar lost some duplex subscribers because of its low and unstable connectivity over the satellite phones. The successful launch of the second generation satellites solves this connectivity problem and increased the quality of voice calls by shortening the travel distance of the satellite signal. In the first 3 quarters of 2014, the company has increased the number of subscribers, thereby increasing the main driver of its revenue. The company has been operating at net losses consistently for the past 5 years. These losses are due to the high expenses associated with launching a new satellite system. However, the growth of Globalstar's subscribers from the second generation satellites will help the company increase revenue and reduce net operating losses. Also, without further capital expenditures on satellites, the company will be more flexible on its use of capital. Currently, the company is able to cover the debt and interest expense with its own earnings, but by the time the company needs to pay off its debt, it must continue to strive for a strong revenue growth in order to pass through the period and find a path to profitability. Because of Globalstar's highly leveraged capital structure, they are exposed to a high risk of bankruptcy. Globalstar has produced negative net income over the past 5 years and is likely to do so again, along with being projected to have negative free cash flow for 2014. Globalstar is relying on loans from its parent company, Thermo, in order to keep paying its debt. If Globalstar is unable to generate positive net income and free cash flow, it may come in danger of being unable to make its future debt payments. There are currently more than 1 billion potentially convertible shares that could have a dilutive effect on Globalstar's share price. Dilution could have negative effects if the stock starts to perform well and the convertible shares are exercised. Also, equity injections by Thermo can cause a dilutive effect on the share price. These occur when Globalstar issues new shares of the company and Thermo buys them in order to help pay off Globalstar's debts. In conclusion, Globalstar's excess spectrum could prove to be very profitable in the future. However, the company is still very risky because of its highly leveraged structure, its dilution risk, and its consistent operating net losses. Therefore, we forecasted Globalstar's 12-month stock price to be $3.80 and give the company a market outperform rating. The Birkenroad reports are produced solely as part of an educational program of Tulane University's Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decisions. You should consult an investment professional and/or conduct your own primary research regarding any potential investments. Thank you for listening.